Hi, everyone. Welcome to RevGen Consulting's educational webinar series, where we take a deep dive into some of the most relevant, important topics regarding your investment strategies. For this webinar, I'm excited to introduce Douglas Ruark, founder and president of Rock Securities Law. Redrock Securities offers a unique combination of securities and corporate law services that's complemented by the firm's investor portal technology designed to administer a capital raise. They advise fund managers under Regulation A, Regulation CF, and Regulation D offerings. All right. Well, thank you for joining us, Doug. We're really thrilled to have you today. So let's start by telling us more about Redrock Securities and your professional background and the types of clients that your firm works with.
Yeah, absolutely. And thanks for having me, Angela. Our firm has been around for 25 years. And we are a full service law firm. We do have focus and specialization in the preparation of securities offerings, specifically under SEC Regulation D, Regulation CF, and Regulation A offerings. So essentially the three primary exemptions that most issuers use when they're going to execute a securities offering. So that's kind of the part A, I call, of our firm, is the law firm and the legal work that gets done to help companies and fund managers put funds together and obviously then go out and syndicate capital. The second side of our business is technology based. Starting in 2015, we created our own Regulation D portal software system. It's essentially a web portal system and software system that administers a securities offering under Regulation D. And so that is kind of part and parcel to what we do. If we're working with a client and they're going to do an offering, we're almost always building a raise portal for them because with these modern securities offerings, where you're out generally soliciting the public, it's almost a default now that you're going to have a portal website that you send that prospect traffic to. And that obviously is going to take them through the investment process. Ours has cap table management and investor relations management on the back end. So that's kind of a second vertical within our firm, is the technology side. And then just as far as myself professionally, I've been president of this company since 1999. I was a founder. So for the last 25 years, I've been immersed in, preparing securities offerings and filing work and, helping clients obviously navigate these programs and execute and help them raise capital.
That's really amazing. Thank you for that. So since your firm has been in the business for, 25 years or so, what would you say has changed when it comes to like the capital raising landscape? Because you talked about, Reg D offerings and 506C. What changes have you seen in the past, like maybe 10 years since like 2012, 2013, and maybe in the last 3 to 5 years? Any like trends or some changes that you've seen in this industry?
Oh, yeah. Well, I think ultimately the Jobs Act of 2012 was revolutionary. Prior to the Jobs Act of 2012, there were very limited options. And I think what was frustrating back then is that the internet was there, right? The internet was fairly mature in 2009, for example. And so it was kind of interesting running the firm at that time, because ultimately you would have clients that want to go raise capital. They want to go out on their LinkedIn and their Facebook, and they want to get out on the internet and raise money. And unfortunately, the programs just weren't there. They had not caught up to what I would say the technology yet. And so the Jobs Act really revolutionized things because it, number one, created Regulation D 506C, because Regulation D was the old traditional private placement exemption. It's been around since 1982. That was kind of the default, that let's say you're a real estate syndicator and it's 2009 and you want to put a fund together to go acquire self-storage properties, for example, you pretty much were doing a 506B. There really weren't other options. And the problem with that is that you can't generally solicit the public with that program. So you were limited then to either, we'll call it friends and family and your kind of close-in network, or you're having to sell through broker dealers that had those relationships. So I think the key with the Jobs Act was it created Reg D 506C, which lets you generally solicit the public. You do need to keep the investment limited to accredited investors only, but that is what a lot of our clients and a lot of fund managers want is they want to deal with maybe higher net worth people. They created Reg CF, and there was actually some enhancements to CF in March of 2021, which made it actually somewhat viable for real estate clients. And then Reg A, Reg A has been around forever, but it was a very cumbersome program to use until the Jobs Act. Now, Reg A was kind of the last one to get upgraded and hit the Federal Register. It was 2015, I think, when that occurred. But Reg A has been fantastic. Tier 2 Reg A is essentially a public offering as far as capabilities without having to go through the process and cost of putting a traditional public offering in place. So I would say that first thing that's changed, Angela, is the rules. They finally caught up to the fact that, hey, we've got to help companies syndicate capital more effectively. We have this great tool in the internet and social media and all of these abilities to reach a broad audience. We've got to give these issuers the ability to be able to do that in a compliant manner. I think the second thing that's changed is technology, and specifically the technology that runs these raises first and foremost. So for example, if we do a Regulation A offering for a client, again, let's say it's a real estate fund, part of the benefit of Reg A, you can generally solicit the public, you can raise money from everyone. But one of the benefits is that the modern technology that runs the subscription process, when I hit that invest button on the portal and decide I want to put 15 grand into this fund, it's 3 minutes, it's E-Trade sophisticated, it's frictionless, and then it's a touch-free process for the fund manager because everything automatically then goes over to the transfer agent for recording. So I would say that the other thing that I've seen that's changed dramatically is the technology that's used to manage the securities offering itself. And then in addition to that, managing your cap table. I think part of what is getting kind of turned on its face is the old syndication model of, we're going to have a $250,000 minimum subscription because we just don't want to deal with a lot of investors. And with the modern technology now that allows a small C-suite to manage a large cap table, thousands, even tens of thousands of investors, it's really flipped the script there now, because you can be a small C-suite. You can be a 2 or 3 man operation as far as running a fund, and you could have 5 or 10,000 investors. And the technology that allows you to manage investor relations in your cap table now is so good that there's no reason not to build that affinity base then, because if you've got 5-10,000 people supporting your real estate fund and you're going to keep expanding your portfolio, that's syndication power right there. So I think those are the things that we've seen change, the rule changes and tech primarily over the last, call it 15 years. Those changes have been significant.
Would you say that like fund managers were eager to structure themselves as 506C? Meaning like, I guess like, I'm just kind of curious to see if there's been any hesitation from some of the, established fund managers as far as getting direct investments from, investors. I get the sense that a lot of fund managers still want to go after the institutional investors, and they feel as though, we don't want to manage this in-house. We're just going to let the broker-dealer channel, manage that. Like, what have you, like, did they like kind of, flock to, oh, okay, I'm going to establish myself as a 506C, or do you think that's relatively more recent where they're recognizing the value of how they can use technology and get the investors themselves?
Yeah. I think it comes down to the client. So I think I do have some clients where they've built an affinity base already, and it is high net worth people or family office money, and they're just not interested and don't need to. They don't really need to hit the kind of retail investor. And I think in that case, then something like a Reg D 506C is great. It still gives them the ability to generally solicit. Their target is accredited investors or family office money, institutional money. So then there really isn't maybe necessarily a need to go to a Reg A, because that 506C is going to give them the vehicle they need to raise that money effectively. I do think that what is happening is that people are starting, a lot of these fund managers and syndicators are starting to realize that Reg A does have some big time benefits. You can still accommodate the family office money. You can still accommodate the accredited investors, but you can also build a pretty big, substantial network of retail investors that, granted, maybe they're putting in 5 to 20,000, but I think part of what we're seeing is that that person that maybe just put in 10 grand into your fund and you head into year two and he's gotten a great return, and now you're doing a second round Reg A and raising more money to expand your portfolio, where guess what? Now he's going to go, gee, I wish I had put in 25 grand in that first one, but I'm going to put in 25 here because I'm getting a great return. The other thing we've seen is that they tend to be your best salespeople. And what I mean by that is if I'm getting this great return on this private real estate fund I invested into, and I'm at the cocktail party or I'm on the golf course, I'm talking about it. Hey, I put money into this self-storage fund, and man, these guys are getting me a great return, and they just launched a new Reg A. Let me send you their link to their Raise portal because you guys are going to need to invest in this. I'm getting great returns. So I think that's the other thing that we're seeing is that, again, as you build that affinity base, most of those people that maybe invest in a nominal amount early, as long as they're getting what they expected, they'll invest more as you go into year two and year three. And then they're also going to bring their friends, family, and golfing buddies with them as far as bringing additional investment in.
And it seems like that's what you want as a fund manager, right? Like your investors are acting as your brand ambassadors to an extent, and they're bringing their friends and family. And I really like what you said about, investors starting out maybe at 15, 20, $30,000 investments, because it seems like, a lot of more mid-sized and bigger fund managers, they're just looking after, they just want the $100,000 or two or $300,000 investors. But I do feel like there's a huge opportunity for emerging sponsors. Maybe the fund managers that are raising maybe 25 million or 50 million to start with, a greater pool of investors and just kind of building their database that way. And I wanted to ask you about that because Reg A, I think from our initial conversation, I wasn't really aware of Reg A, and I wanted to learn more about what types of fund managers would benefit from that structure, and like what you would recommend. Like, if you have a choice between 506C and Reg A, like what would you recommend? And also, if a sponsor, if a fund manager is already structured as a 506C, can they possibly have their next fund structure as Reg A? Could you talk more about that?
Yeah, well, and I think, look, if you've got a fund manager and they've got a deep family office network, and it's like, hey, we're launching fund two, or maybe we have a specific syndication we're going to do. We need to raise $40 million, and I've got three family offices that I know they're going to invest with me. I mean, again, we keep it simple and we'll do something like a Reg D. So I do think some of it comes down to what are the specific needs of the client. One of the things that I found with Reg A, and you really just touched upon it right there, is that I think for some of the emerging fund managers and sponsors, it is a great tool that maybe they don't have that network of family office money and institutional money to tap into. It doesn't mean that they can't raise a lot of capital. They're just going to be doing it from the retail, the public. The other thing too is again, I'll stress that the technology that allows you to manage these people once they're on their cap table is phenomenal. And I get it where you might have a guy that goes, I don't know, like $5,000. Like I'd really want more from someone if they're going to be on my cap table. But I think once they see the tech and they understand that it's not that big of a deal to manage that person, and in fact, they're probably going to be very passive. They're going to be, I only got 5 or 10 grand with this fund. Like they're not obviously going to be calling you every week looking for updates. It then starts to kind of make sense why then again, as you head into year two, year three, that original $5,000 investor may end up being a $50,000 investor within the fund within a couple of years. I think with 506C, I have had clients, I've had plenty of clients actually, where they originally funded their fund with a 506C. They went out to the accredited crowd. They start building the portfolio. They kind of start building their infrastructure if they are maybe a new syndicator or sponsor. And then from there, then what happens a lot of times is they just come back to us and say, hey, we got a ton of non-accrediteds that were interested in our original offering. It was a 506C. We couldn't accommodate them, but it's obvious that we've got 15 or 20 million sitting there on the sidelines that's just immediately available if we put the proper vehicle in place. The other thing too with Reg A is it does have some unique benefits. One of which is freely trading securities out of the gate. So it's not like a Reg D where you're typically Rule 144 restricted on resale for a year. The other one that's interesting is the selling shareholders feature. Reg A does let up to 30% of the offering be what we call selling security holders. And that's essentially people that are on your cap table that can actually sell their fund interest through the Reg A. Now, A lot of times we may not see that on an initial Reg A because it may be like a brand new fund and there really is no one on the cap table, obviously. But you go into year 2 or year 3 with that fund, and it is an interesting option then, because what you could do is you go into year 2, you go back to all the people invested in year 1. Hey, everyone, we're doing our second Reg A offering. We do have the ability to list some of you as selling security holders. So if you wanted a liquidity event, you can actually sell your fund interest through the Reg A at whatever that year 2 Reg A price is going to be, and then they have a compliant method to be able to sell their securities. They're essentially selling their personally held securities to new investors, and the proceeds are going to them. So certainly a fund is going to probably have other liquidity options. They'll probably have redemption options that they've kind of built into their governance docs and what have you. They may even get linked up with an ATS, an alternative trading system that allows liquidity. But the selling security holder feature of Reg A is unique to Reg A, and it's kind of interesting when you look at a real estate operator, for example, where they bought physical assets. They're not interested in selling those assets to unlock capital to exit people. They want to hold that portfolio for 10 years. So as long as they're doing a Reg A each year they'll have an opportunity to go to their shareholder base and potentially provide liquidity to those people through that feature.
Oh, wow. That's actually fascinating. I did not realize that was a feature of Reg A. Okay. And are you seeing that more, have you seen any changes in your client base where they are starting to raise they want more direct investments from accredited investors or maybe non-accredited? Have you seen any changes in the way that they're, I guess, marketing themselves and also just trying to get the investments?
Yeah, I think a lot of that does still come down to the client. I do have some clients that are fairly well established and they're sophisticated. They've got in-house marketing, they've got a deep affinity base. Usually these are sponsors that have been running funds before. So a lot of times when they launch a new fund, they're going out to their base of current investors for fund 1, for example, or maybe they've started a multifamily fund and their prior fund was like a VRBO vacation rental fund or what have you. For sponsors that maybe are still kind of building that affinity base, there's a lot of really unique ways to go out and market these. And again, a lot of it would come down to the client. I have some clients that have that capability in-house. They have marketing professionals on their team that can set up content, deploy that content. There are also investor acquisition marketing firms out there that specialize in setting up content and then going out and getting PR for the fund and the offering, and obviously getting exposure for the offering and the fund. We're seeing webinars used a lot. I'm a big fan of that. I think number one, it gives you the ability to put something out on social media. Hey, everyone, we've launched our multifamily real estate fund that's focused on the Austin, Texas market. And we're running a webinar Friday at 2 p.m. Eastern to talk about the fund, why we think this is a fantastic asset class, and obviously our existing Reg A offering that's in place. And yes, it gives you just something, number one, to put out on your social media to stay in front of people, but it also is a great way then to interact with potential prospects where they get a chance to see the management team, hear from the management team, hear from the sponsor, and then I think from there, do a question and answer. And what we found is in the days following a webinar, the investment activity on the portal spikes. And what that is what I call your 80 and 90 percenters that you've gotten across the finish line. Meaning, if I'm on the webinar, I've probably already gone to the Raise portal. I've probably already reviewed the offering circular. I'm interested. I'm, like I said, 80 to 90% to the finish line. So I get on the webinar, I see the management team, I kind of hear their pitch, and that's usually what kind of then puts me to the point where I'm like, you know what, I think I'm going to invest in this offering. So that's one of the things that we've seen. But yeah, I mean, again, the freedom to be able to get into the public domain and promote and be creative with your promotion is fantastic. And it, like I said, it really is all of it's coming out of the 2012 Jobs Act changes.
And you know, your investor portal technology, that it really seems like a game changer. Like, how did you come up with that? Like, how did you and your team, you know, decide, okay, this is what the fund managers need, and that streamlines the entire process because you're essentially making it very easy for the fund managers to manage their investor relations and manage their investor base, and investors can also, you know, it just makes it easy for them to invest. Like, how did you come up with that technology and you know, how did that sort of how has that been progressing?
Yeah. Well, I think what happened was is when we saw the Jobs Act pass and we saw 506C come out, we kind of sat and thought, all right, well, now people are going to be out promoting in the public domain. They're going to be on their corporate websites. Hey, everyone, we're raising money. If you're an accredited investor, come invest with us. And it just kind of became apparent that it would be very beneficial to develop a system that would engage these investors and then track them through the process in a compliant manner. And then, the other thing that we, pretty quickly realized was, okay, well, if we're going to build this platform and build this tool for the offering, why not go ahead and build in cap table management, investor relations management. We even have an asset portfolio feature for our real estate clients where if you got, 15 self-storage facilities in the fund, you show that portfolio in real time. And I think we were uniquely suited to build it because, we had 15 years of experience in this industry. We understood the processes. We understood how information needed to be handled. So I think it was just that it was looking at 506C at least initially and saying, okay, well, this would be a great tool because people are going to want to go out on their Facebook and their LinkedIn, their corporate site, and they're not going to want to handle things the old school way. It's not going to be email stuff back and forth. So the other benefit is that if there was ever a compliance audit from, say, a state regulator where they want to come in and review everything that has occurred as far as the security sales, having a robust system like that, technology managing everything, tracking everything. I mean, like our system has a tracking slider that shows every single thing that investor prospect has done as far as tasks, everything they've signed, everything's archived. I mean, so to use a system like that if you did have a state regulatory audit or even an SEC audit, it's going to be a very easy audit to manage because everything has been managed using technology and literally right in the admin side of that portal is a user table that shows every single investor. You can click on that investor and it'll literally show everything they did from the moment they hit that portal. It's got all of their information archived, their verification documents, everything. So I think that was the other thing that we looked at is, hey, this is going to be really beneficial where if there's an audit and a state securities regulator shows up to review everything, that you're not pulling manila folders out of filing cabinets and gee, where's Mr. Smith's subscription document? Oh, maybe he emailed it. No, everything's been done on the portal. Everything's been tracked and it's all sitting right there for that regulator to review.
That's amazing. That's actually a benefit I don't think that a lot of fund managers would even think of. Oh, wow.
Yeah.
Okay.
Well, the other thing it positioned us to do then is for like Reg A's, when we build a Reg A Raise portal, it does have a different back end because you have a broker dealer on board, you got transfer agent on board. So we're usually then integrating invest tech from one of those vendors. But again, having web developers, software engineers on staff, it just put us into a great position there where it's like, okay, we're going to do a Reg A, you're going to want a raise portal. And then obviously the rest of the industry caught up as well, specifically broker dealers and transfer agents, where it's like, okay, well, people are going to hit an invest button. They're going to go through an investment process on this portal. Let's build the pipeline that gets the information automatically over to the transfer agent and have it obviously record into their system. And, for these CFs that we've been doing, and I'll mention CF real quick. I mean, CF limits you to $5 million in the 12-month period. We actually have had real estate offerings done under CF. Sometimes there's smaller specific asset acquisitions. Hey, we need 2 million in equity to buy this, office building, for example, or what have you. We've actually had clients start real estate funds with it where they're going to start with 5 million in equity, leveraged up. That might get them 20, 25 million in purchasing power. And if they're buying smaller assets, if they're building like a single family rental pool, it at least gets them started. The thing to keep in mind with CF is you have to have a broker dealer on board if you're doing it what we call direct, where you're bypassing going up on the crowdfunding platforms and you're going to have your own website built to run your raise, that site's got to be owned and administered by a broker dealer. So when we do our CFs, we're not only getting the legal work done, but we're also aligning them with a broker dealer, and then we're also going to build a raise portal that'll run the raise. So I think if it's a smaller sponsor, or maybe they're just getting started and they just want to kind of get out with Reg A capabilities, but they're not ready to step up to a Reg A yet, those CFs can be a potential option for them.
That's interesting. I didn't realize that CF requires a broker-dealer involvement. So, okay.
Yeah, Angela, it requires one of two execution methods. You're either going up on an approved crowdfunding platform with
Hmm.
400 other deals, or you're executing on a custom built portal, and that portal is going to be owned and administered by a FINRA broker dealer. And that was that March of 2021 rule change I mentioned earlier in this webinar, that CF got a pretty big upgrade in March of 2021 because they took the limit from $1 million up to $5 million. Which then opened the door to some real estate stuff happening. Like, hey, I need $3 million to, in equity to buy this, self-storage facility. All right, well, great. Well, CF's now an option, whereas prior to March of 2021, it wasn't. But it was in that set of rule changes that they then opened the door to a FINRA broker dealer serving as what's called the intermediary. They have an intermediary. The intermediary is either the crowdfunding platform or it's the broker dealer. But the reason why they have the intermediary is they're essentially giving you public offering capabilities with the CF. You can generally solicit public, everybody can invest, but they're not approving it like, that's not going through a qualification process like a Reg A. It's not getting, approved like an S1 would. So that's where they have that requirement of, okay, well, we're going to give you these capabilities, but you're going to have that intermediary on board because we know the intermediary is going to run compliance, whether it's a FINRA broker dealer or whether it's an SEC approved crowdfunding platform.
Oh, okay. So it's one or the other. You're saying, okay, thanks for clarifying that. Okay. So for emerging sponsors, let's say that I come across, quite a few fund managers that are looking to raise their first maybe 25 to 50 million. Would you recommend that they continue to explore? They only really know 506C because they know that they want to get direct investments. But I feel like Reg A is still something that they're not necessarily, maybe they're knowledgeable about, or maybe they aren't really looking at it because they think, oh, it has to be accredited investors. Like, what would you recommend for emerging sponsors that are looking to raise their first 25, 50 million?
Sure. Part of what I would run them through really is the process for both. I mean, I think the benefit of Reg D 506C is that it is the most streamlined option. It's get some legal work done and get some offering docs drafted. There's a short notice filing to the SEC and, build a raise portal and you're off and running. So I think that's the benefit with the Reg D approach, is that you're going to have lower prep costs. You're going to have a shorter time frame to prep that legal work to get launched. You're not going to have, beyond your Form D notice filing, you're not going to have semi-annual and annual reporting and what have you. You're not required to have audited financials with a Reg D 506C. So I think part of the conversation there with that potential client is what kind of capabilities you're looking for, what timing are you looking for, and what's your budget? Because some of these sponsors may not be ready to step up to a Reg A as far as the prep cost, the responsibilities of maintaining audited financials, if it's a tier 2 Reg A, or timing. Like, they may just need to be like, hey, we need to be out raising money in 45 days. I mean, you're just not going to get a Reg A prepped and qualified in that time frame. So, but if they are willing to, have a little bit longer prep time frame, spend a little bit more money on the legal work and the prep as far as the offering itself, Reg A opens up, then obviously the door for Reg A opens up. So I think when I'm kind of dealing with someone, that's part of what I'm getting them to look at is, here's the preparation aspects of each offering. Reg A is certainly going to be more complex and sophisticated to prepare. I mean, look, if you're using a firm like ours, we do it day in and day out. So obviously we make it as painless as possible. But it is essentially an S1 filing we're drafting. So it is a robust filing that's getting drafted. And then it's obviously got to go into the SEC and go through a qualification process. So that's, I think, part of the conversation there, Angela, because I've actually had, people come in and they were kind of really focused on 506C. And then when they got introduced to Reg A and they saw what the, what the timeframes look like and the budgets and stuff, they decided, hey, you know what? Actually, we're willing to pay more and wait a little bit longer to put in place an offering that gives us those capabilities. So I think it just really comes down to the client, because those key things really are going to kind of drive what that decision looks like as far as which program they go into.
Oh, okay. Oh, that's very insightful. Thank you for that. So what do you think is the future for, fundraising and, just capital raising? And like where do you think like, as far as like, seeing your clients and, not only the way that they structure themselves, but the ways that they are raising capital, what do you think is sort of the future of this fundraising landscape?
I really think that more and more issuers probably are going to shift to a Reg A type approach. I
Mhm.
think the more people start to understand the technology that's available for managing cap table and managing investor relations, I don't think they're going to be afraid to have 5 or 10,000 people, participating in their fund. And like you said, they end up being brand ambassadors. Again, I will say that it still comes down to the client, because if I've got a client and they've got a deep base of just high net worth people and family office money, and that's how they've been funding their syndications, and maybe there's no reason for them to go to Reg A. But I think what we're seeing is a lot of sophisticated marketing that's really going out as well, that you get public offering investor acquisition capabilities with the Reg A, and you pair that up with a sophisticated marketing campaign. You can syndicate a lot of capital pretty quickly. I think ultimately, I still see people launching with traditional securities. I realize that crypto and tokens and fractionalizing real estate using the token stuff is there. I still believe that in most cases, using a token to raise money for real estate, you're pretty much creating complexities that don't necessarily need to be there. At least now, at least at where we stand now. So I do think that I still see issuers using traditional fund structures, LPGP structures, manager managed LLCs. Maybe if it's going to be a true tax advantaged REIT, maybe they'll launch as a corporation. So maybe the token stuff changes. I do know that the SEC is, the moment they see token on something like a Reg A, they're going to scrutinize it more. It's just the way it is. But I think the future really is the technology. I think it's already perfected. It'll probably continue to get even better, but I think ultimately it's going to be, making it as seamless and frictionless as possible to invest, and then making it as seamless and frictionless as possible to manage that person once they're on your cap table. And the tech right now is fantastic. I'm sure 10 years from now, it's going to be even better.
Absolutely. Oh, that's wonderful. Well, Doug, I really appreciate your insights today. You breaking down the Reg A and also covering Reg CF and Reg D offerings. I think that a lot of emerging sponsors and, fund managers out there looking to raise a, next fund, they definitely can learn a lot from you. So where can they find you? RedrockSecurities.com. Can they connect with you on LinkedIn?
Yeah, absolutely. So we're on the web at redrocksecurieslaw.com. And we're obviously on LinkedIn, Facebook. They could also call our offices, 720-586-8610. That's our main line. And they could obviously reach out to me on LinkedIn if they want. My email is pretty straightforward. It's doug@redrocksecurieslaw.com. And would really be happy to obviously engage in conversations. I mean, part of what I actually enjoy is the educational aspect of this. And so I always look at kind of my first calls with a prospective client as really running them through a lot of what we ran through today on this webinar, which is what are the options, what are the advantages, what are the disadvantages, what's changed in the last 5 or 10 years. Because I've got syndicators where they haven't done a syndication in a while, and they decide to get back into the real estate game, and they're amazed at where the industry is now as far as going and syndicating capital. So more than happy to chat with anybody as far as where we are as far as the industry and the programs, and obviously our capabilities with Redrock Securities Law and Redrock Investor Technology.
That's wonderful. And, we would love to have you back for more discussions. This was really, really, informative and, I can't wait to share this. So thank you so much, Doug. Thank you for your time.
Absolutely. Thank you, Angela.